Yeah, the money MC.
Most people think investing is about watching numbers go up, waiting to sell at the right moment, trying to time something that cannot be timed.
I want to show you something different.
There is a type of investing where you do not have to sell anything, where you do not have to watch the ticker, where companies pay you in cash directly into your brokerage account just for being a part owner. 4 times a year automatically, whether the market is up, down, or sideways.
It is called dividend investing. And it is how some of the wealthiest long-term investors on earth have quietly built their fortunes.
Not by chasing the hottest stocks, by owning boring, reliable businesses that never stop paying them.
Today, I'm going to show you exactly how it works.
How to find the right ones.
How to build an income from scratch.
And why starting right now,
even with $50 a month,
changes everything.
Let me explain dividends in the plainest possible language. When a company earns more profit than it needs to run and grow its business, it has choices. It can reinvest that money. It can buy back its own stock. Or it can pay its shareholders directly. Companies that choose to pay their shareholders do so through dividends. Cash deposited into your brokerage account. Usually 4 times a year. You do not have to sell anything. You do not have to time the market. You just own the shares. And the company pays you a portion of its profits simply because you are a part owner. Dividend yield is how you measure this. If a stock trades at 100 and pays 3 per year in dividends, its yield is 3%. Put 10,000 in. You receive 300 per year in cash. Automatically, regardless of what the stock price does on any given day. The market can swing up and down and your quarterly payment still arrives. Now here's where it gets powerful. With dividend investing, you win 2 ways simultaneously. First, the dividend income itself, cash in your account 4 times a year, growing over time as the company raises its payout. Second, share price appreciation. The stock also grows in value over time. Just like any other stock, you collect the income and the growth at the same time.
Here is the number that proves why this matters.
A 10,000 investment in the S&P 500 at the end of 1993 grew to 100,000 by the end of 2020. Plead without dividends reinvested. The same investment with dividends reinvested. Oh, 182,000. That 80,000 gap is entirely from dividend compounding.
And here is the deeper truth. Since 90 cents, the approximately 85% of the cumulative total return of the S&P 500 has come from reinvested dividends and compounded, not from stock price gains alone.
there are 2 tiers of dividend-paying companies that every serious investor needs to know about. The dividend aristocrats.
These are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years.
Not just paid a dividend, raised it. Every year without exception. There are currently about 68 of them. Companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, Chevron, McDonald's, Lowe, Target.
These companies raised their dividends through the dot-com crash,
2008 financial crisis, through COVID-19, every single year without cutting, without pausing.
The dividend kings.
The kings are the tier above companies that have raised their dividend for at least 50 consecutive years. There are 57 of them. Procter & Gamble has raised its dividend for 69 consecutive years.
Coca-Cola for more than 61 years. These companies were raising dividends when Nixon resigned, during the 1987 crash, during the dot-com collapse, during the DARPA days, during COVID. to raise your dividend every year for 50 years. You need consistent earnings growth, disciplined management, durable competitive advantages, a strong balance sheet. The dividend streak is a signal of business quality, because weak businesses cannot sustain it. These companies tend to sell things people buy in every economic cycle: toothpaste, soda, medicine, cleaning products. Energy businesses with pricing power that work whether the economy is booming or contracting.
And the historical performance reflects it. Dividend Kings delivered approximately 11.36% annualized returns over 20 years versus 9.2% for the S&P 500, with fewer down years and smaller losses in bad markets.
There's a tool inside dividend, investing that most people never activate. It is called DRIP, Dividend Reinvestment Plan. Here is how it works. Instead of taking your dividend payment as cash, you automatically use it to buy more shares of the same company. Those additional shares then generate their own dividends at the next payment, which buy more shares, which generate more dividends, which buy more shares. The snowball rolls continuously without you doing anything after the initial setup. The math on this is staggering. Consider a $10,000 investment earning an 8% dividend with 4% annual dividend growth and 5% annual price appreciation with all dividends reinvested. After 10 years, that 10,000 becomes 32, 4 fixing 9. After 20 years, 10 that bang, 710. The same investment without drip built to a fraction of that. The reinvestment is where the compounding lives. Without it, you are leaving the most powerful part of the return on the table. Now here's the part that should make you stop.
Drip is not complicated. Drip is not expensive. Drip is one click inside your brokerage account. At Fidelity, Vanguard, and Schwab, dividend reinvestment is a free account setting. You go in, turn it on, and every time a dividend payment arrives, the brokerage automatically uses it to purchase more fractional shares. With no fees, no action required from you, the compounding runs in the background while you live your life.
And there's a time and advantage built in the drip that most people never think about. When markets drop, which they will, your automatic reinvestment buys more shares with the same dividend dollar because the price is lower, more shares for the same money. When markets rise, each share is worth more. Over time, this dollar cost averaging effect smooths out volatility and systematically lowers your average cost per share. The market's worst days are actually your drip's best days.
Turn it on, leave it on, let it run.
Before I show you how to pick dividend stocks, I need to warn you about the most common mistake.
Chasing the highest yield.
A 10% dividend yield sounds incredible, 15% sounds even better.
Free money, right?
Wrong. A
A Wellington management study divided dividend, paying stocks into groups based on yield level and tracked which perform best over time.
The result, second-tier stocks,
Those with high
but not the absolute highest yields.
outperform the S&P 500 in 7 out of 10 decades.
The highest yielding stocks only beat the index about 60% of the time.
The extreme yield is not a gift.
It is often a warning.
Here is why.
Dividend yield is calculated by dividing the annual dividend by the stock's current price. When a company's stock price falls sharply because the business is in trouble, the yield goes up automatically.
A stock paying 5 pies per year that falls from 100 to 50 dollars.
Suddenly shows a 10% yield that looks attractive.
But the reason the price fell is because the business is struggling,
And a struggling business is about to cut its dividend.
often by 50% or more.
When it does,
The stock price usually collapses further at the same time.
you get the cut and the price drops simultaneously.
That is the yield trap.
The payout ratio is your warning system. This is the percentage of earnings a company pays out as dividends. Think of it like a household budget.
If you spend 40%
Of your income on housing.
sustainable, you have room for emergencies.
If you spend 75% or more on housing,
One bad month could break you. Companies with payout
ratios above 75 to 80% are in a fragile position.
one bad quarter and the dividend gets cut.
The sweet spot for safety is below 60%. The company earns more than it pays out, retaining capital to grow and absorb downturns.
The rule on yield.
2 to 5% from companies with strong fundamentals and payout ratios under 60%. That is the zone where sustainable wealth gets built.
4 numbers. That is what you need to evaluate any dividend stock.
Number 1, dividend yield. The annual dividend divided by the current stock price.
Your baseline return from dividends alone.
Target range
2 to 5% for quality companies.
above 6 to 7%.
Investigate why the yield is that high.
Before you buy anything.
Number 2.
Payout ratio. Annual dividends per share divided by earnings per share. What percentage of profits being paid out? Under 60% is healthy. The company keeps enough to grow and absorb trouble. Above 75 to 80% is a warning. The company is paying out most of what it earns and has little buffer if earnings dip.
Number 3.
Dividend growth rate.
How much has the dividend increased per year on average?
Company consistently raising its dividend.
5 to 10% annually is giving you a raise every year without you doing anything.
The power of this over a decade is extraordinary.
A stock you bought at a 3% yield
10 years ago might now be paying you a 6% yield on your original investment.
because the dividend kept growing.
While your cost stayed fixed.
That is called yield on cost.
And it is one of the most powerful forces in long-term dividend investing.
Number 4.
Consecutive years of increases. How many years in a row has the company raised its dividend?
This is the single most important signal of dividend reliability.
Aristocrats at 25 plus years. Kings at 50 plus years.
Even 10
to 15 consecutive years of increases indicates a company that takes its dividend commitment seriously.
Look for this number before anything else. Yo, the Money MC.
6 moves in order, starting from wherever you are right now.
Move 1.
Build a foundation first.
Dividend investing works best inside a tax-advantaged account, specifically a Roth
IRA.
Here is why. Dividends in a regular taxable account are taxed in the year they are paid, even if you reinvest them inside a Roth
IRA.
Every dividend, every
Reinvestment, every dollar of compound growth is completely tax-free forever.
the combination of drip plus a Roth
IRA is one of the most powerful wealth structures available to regular people.
So before you build a dividend portfolio,
Make sure your Roth IRA is open and funded.
move 2.
Start with one ETF.
Do not start by picking individual stocks. Start with SHD or VIG.
One fund, open your account.
Fidelity, Vanguard, or Schwab. Purchase shares. Set up automatic monthly contributions.
Enable drip in your account settings.
That is the complete setup.
It takes about 20 minutes total, and the compounding begins immediately.
As your confidence and portfolio grow,
You can begin adding individual aristocrats and kings.
but the ETF is the right first step.
for most people.
Move 3.
Automate your contributions.
Set a fixed monthly dollar amount.
Whatever your budget allows.
50 down.
100, 300, 500, this.
Auto transfers from your checking account on the same day. Every month the purchase is more shares.
This is dollar cost averaging in action.
In months when the market dips.
Your money buys more shares.
In months when it rises.
Your existing shares are worth more.
Remove the decision, remove the emotion.
Let the system run.
Move 4.
Understand why starting out beats starting with more later.
This is the most important move and it requires no money.
It requires understanding one number. A 22-year-old who invests 2,000 per year.
For just 5 years.
A total of 10,000.
And then stops completely.
At 9% average annual return.
Reaches 344.
9 and 10 by age 65.
A 30-year-old who waits just 8 years and then makes the same exact investment.
2,000 per year for 5 years.
Reaches only
73,098.
098.
65.
The same total contribution.
8 years of delay.
The result is cut nearly in half.
That gap, 71,000 is the cost of waiting.
It cannot be recovered by putting in more money later.
Time is the one input that cannot be replaced.
Move
5 AD individual aristocrats and kings over time.
Once your ETF base is established,
Start learning the individual companies. Procter & Gamble. 69 years of consecutive dividend increases. Consumer staples, sales products in every economy. Coca-Cola.
61 plus years.
Global reach.
Pricing power.
Recession.
Resistant Johnson.
And Johnson.
62 years.
Healthcare and pharmaceuticals. Realty income.
Monthly dividends.
Real estate investment trust.
Pays every single month rather than quarterly.
These are the companies whose products you see every day.
Start with the ones you understand.
1 or 2 per year.
Build a portfolio of 15 to 25 individual aristocrats or kings.
Alongside your ETF core.
Move 6.
Reinvest early.
Collect later.
The optimal dividend strategy has 2 phases.
Phase 1.
Accumulation.
Lasts 15 to 20 years.
Every dividend gets reinvested automatically.
You never touch it.
The compounding runs at full power.
Phase 2.
Income.
Starts when you need the money.
You turn off drip in the dividend.
Start flowing as cash.
Income instead of more shares.
What you have built over 20 years of compounding
Is now an income machine that pays you monthly or quarterly for the rest of your life.
the sequence.
Reinvest aggressively.
Spend later.
Is the strategy that creates genuine financial independence from dividend investing. Let me show you what regular monthly contributions into a dividend ETF actually produce. 100 per month in the SHD with DRIP enabled at its historical 12% total annual return after 10 years. Approximately 23,000 after 20 years. Approximately 96,000 after 30 years. Approximately 349,000 at 30 years. With SHD's current yield of around 3.8%, that portfolio generates roughly $13,200 per year in dividend income. Over $100 per month, paid to you automatically without selling a single share from $100 a month. The amount you started with was not the point. The time was the point. And here is the current environment context. S&P 500 companies are currently paying out about 36% of their earnings as dividends, significantly below the 98-year historical average of 56%. That means corporations have enormous capacity to raise dividends in the years ahead without straining their finances. The companies are holding more cash than ever. The dividend growth runway is long.
Yeah. Yo, the money MC. Baltimore. Fist. Washington, D.C. Pittsburgh, PA. Long Beach, California. Coming to see motherfucker, hallelujah. Yeah. Dividend investing is not exciting. It does not go viral. It does not have a ticker that spikes in a day. It just pays you quietly every quarter for the rest of your life. Procter & Gamble has been paying and raising its dividend for 69 consecutive years. Through every crash, every recession, every crisis, the check keeps arriving. Build something that pays you, start now, let it run. Subscribe to the Money MC. Share this with someone building their future. Stay smart, stay solid, stay free. We out.